Welcome to Kitco News. I'm Niels Christensen. We're here at Mines and Money in Toronto. I'm joined by Martin Murenbeeld, president of Murenbeeld Company and keynote speaker here at Mines and Money. Welcome.
Oh, thank you. Thank you for having me.
I was reading your weekly report that comes out every Friday, and it surprised me. You always have a little geopolitical premium on golds. This week, there's nothing there, and I'm sort of wondering, what role do you see gold playing as a safe haven now?
Oh, I think gold is still very much a safe haven, but the sad fact of life, at least as I have interpreted it, is that the safe haven through this whole period, particularly with the trade war with China, the safe haven has actually been the dollar. And I've written about that in the reports. I mean, the U.S. economy is still the biggest economy in the world. The investor doesn't necessarily know the fallout of all these actions against China and against some of the other U.S. trading partners. So I think investors generally have decided to escape into the U.S. market.
Is that working for them? Because, last week we saw equities go down. Are the cracks starting to appear, and does gold look good now?
Well, let's put it this way. There's always a crack here or there, and then the question is whether the crack gets patched up. Equity markets correct all the time. I showed a chart today to indicate that we had very large corrections in the U.S. equity market in 2011 and in 2015, and these corrections, they took 6 months or so to give way to new highs. We're going through another bit of a correction at the moment. The question is, if the equity markets are now going down, this is a great day for gold. Okay, but if equity markets go back up, it's not going to be so good for gold. The correlation between the equity markets and gold has been quite negative over the last 4 or 5 years. So, and that's something to remember. Okay, so, with the equity markets in the U.S. having done very well, I, as an investor, have actually been very happy to see 95% of my portfolio do very well and 5% of my portfolio in gold not do so well. But specifically to gold, and let's just focus on that, it is negatively correlated with the equity market. So if the equity market starts to rebound again, which is more than 50% likely because the U.S. isn't yet heading into recession. Okay, so that leads me to have a little bias to the equity markets doing somewhat better. The rest of the world will still want to be invested in the U.S. because, look what's happened in the equity markets in China, in Asia, in the emerging markets, and in Europe.
Well, can the U.S. stand alone? We are seeing geopolitical uncertainty in Italy. We're seeing geopolitical uncertainty in Saudi Arabia. Like you say, China equity markets, European equity markets struggling. Can the U.S. go it alone?
Well, it's maybe not a widely known fact, but if you add Canada and Mexico to the United States, you got North America. North America is pretty damn self-sufficient. It's not as if the U.S. necessarily needs the other countries economically. Now, obviously, it's very nice for U.S. consumers to get products from other countries that are cheaper and possibly just as good as such products would be made in the United States. But I don't have a problem. If you look at the equity markets over the last couple of years, it's the U.S. equity market has separated from the rest of the world quite smartly, and I think this is partly because of bad old Trump, who has made the U.S. more attractive, whether he meant to do it that way or not.
Tax reform and
exactly.
Equities still look viable. And you said,
I don't think they're going to do as well as they have done. Okay, because we are inching towards the day when the U.S. economy is going to start slowing.
So what gets us above? You were saying, the key to watch is 1250. What gets us there? And can we get there when inflation is really lackluster? Real rates are ultimately going higher because inflation is just not there.
Right. Okay, well, we can do hypotheticals. I mean, there's a number of things that can happen to get gold to $12.50. The US dollar can roll over somewhat. Okay, now I actually thought that this was going to happen this year because I thought the Trump administration was going to push on that side. Instead, they pushed on tariffs, which has the ironic effect of actually strengthening the dollar somewhat. So the dollar rolling over, which is, I think, the end game in the Trump program. Okay, so that can happen. The Fed could suddenly pause. Let's say that I'm wrong on the equity market. Let's say that we're actually looking at the beginnings of the slippery slope into recession. So then the Fed pauses. Okay, and maybe it even cuts. Okay, now I think that's reaching a bit, but the Fed could pause for a minute. That would change the dynamics in the gold market. Okay, so the dollar and the interest rate, those two things have to change a little bit. Okay, now other things could happen. I mean, there could be, the U.S. could call China a currency manipulator. I don't think that's going to happen, and that's going to create all kinds of other problems. So you could suddenly get a geopolitical, financial kind of crisis factor kicking back into the gold market, and that would do it.
Okay.
So I think eventually gold is going to go there, and our base forecast is for gold to go into the 1350 to 1400 range by the end of next year. I had first thought that would be the case by the end of this year, but the way the Trump policies have unfolded,
you can't ignore the economy.
That's right.
Ignore the U.S. economy. That's perfect, Martin. I thank you very much for your time. Thank you for coming. Thank you for joining us on Kitco News.
Great.
Stay tuned for more interviews from Minds and Money Toronto.